Welcome friends to our seventh video grooming session for stock market beginners. This is our video on P ratio and valuation of stocks. So these are the valuation tool of a stock. P ratios, ROE return on equity, PB ratio price to book value, ROC return on capital employed, ROIC and FCF. What is P ratio? P ratio is price to earning ratio, or else it is also called price to EPS. ROE ratio is an indicator of how much company is making for their stockholders. PB ratio is a measurement of how much company owning hard assets or the book value of the company. ROC is return on capital employed, how much company is making on capital employed. And ROIC is return on invested capital, and FCF is free cash flow and discounted cash flow. So what is P ratio? P ratio is indication of how much company is making on applied capital of a stockholder. For example, you have a price of 100 rupees and you are earning 1 rupees. It means you are getting 1 rupees as a profit. So P ratio is 100. It means the yield of your capital is 1%. So P ratio is a basic valuation matrix, and P ratio is so useful to value stock. Indirectly, P ratio is telling how much you are making money on your applied capital. P ratio is a very crucial indicator to find out valuation. So valuation is an intricate art. Depending solely on one ratio like P ratio can present an incomplete picture. A high P ratio might hint at a growth potential, but it could also sign of overvaluation. Here you can see that this is a Nifty 50 index chart. So you can clearly see that the lowest P ratio of Nifty 50 is 12 in the year of 2009. After that, there is no any possibility, or though there is no any incident when P reached to 12.12 P again. The last corona fall, the P reached to 19 or 20 maximum. Right now, our trailing P is nearby 20 or 19, so it is reasonable. So, ignoring industry benchmarks. So, context matters. A P ratio 20 might be a sim steep for a utility company, but reasonable for a tech startup. Always benchmark ratio against the industry standard for a clear perspective. So this is a meme regarding this. I have found from internet. I don't know the sources. The courtesy belongs to them. So if the P, which P is good for investment? If the P is greater than 26, take a long holiday. We are talking about Nifty 50 P, the index P, right? If P is between 26 to 23, read books. If P is between 22 to 20, invest cautiously, keep market crash fund. If P is between 20 to 70, keep investing. If P is 17 to 15, increase investments. If P is between 15 to 12, break FDs and invest. And P is less than 12, borrow, take loan, steal and invest. It is just a joke, but it is a very wonderful meme showing the picture of which P is a good for investment. So right now our trailing P is 20, nearby 20. So invest cautiously and also keep market crash fund. But whenever you get chance of P 70 to 20, it is a good investment opportunity. So P ratio should be matched with growth of the company. So if the high P ratio but growth is not there, it indication of higher valuation. Earning power is high but P ratio remain high. So if the company is performing well, or those kind of company who is performing very well, it's going to remain a high P ratio. If the earning power of the company is low, P and P ratio high is a direct indication of overvaluation. So more information you can find out in these websites. Thank you friends. Stay tuned for next video. Bye bye. Jai Hind.